feel really good about MLPs continuing to grow their distributions and grow their payouts. And so not only do MLPs have, a higher yield than broader energy, they have a higher free cash flow yield.
All right, joining me will be JD Gardner, founder of Aptus Capital Advisors, who back in October, they rolled out a series of buffer ETFs, defined outcome ETFs, which I would say these ETFs are pretty straightforward. They offer a 15% downside buffer, and then there's the usual upside cap. But the kicker here is that the expense ratio on these is only 25 basis points. 25 basis points, which makes them the lowest cost buffer ETFs on the market. Now, I should note there are some buffer fund of funds ETFs, which are cheaper, but if you add up the total expense ratios with all the underlying holdings, they're much higher altogether. It's not even close. And so I'll tell you, I found Aptus launching these ETFs very interesting for two primary reasons. Number one, buffer ETFs have generated a lot of debate. And I think one of the key areas naysayers have pointed to are the fees on these products, because it's not unusual to see expense ratios of 70, 80, 90 basis points. The other reason I found this interesting is because you don't typically see a smaller issuer undercutting the larger issuers on fees, right? It's usually the other way around. Now, to be clear, Aptus isn't some little upstart issuer. This is a $6 billion firm, and actually one of my favorite ETF success stories, but they're certainly not as big as many of the players competing in the buffer ETF space. And so JD and I will discuss why Aptus did decide to get involved here. We'll talk about the pros and cons of buffer ETFs in general, even beyond fees. And then if we have some time, I'm hoping we can look at an Aptus ETF or two outside of these buffer ETFs, because they do have a number of pretty unique risk managed strategies. Now, to start this week on a completely different note, I'll be joined by Stacey Morris, head of energy research at VettaFi, who is going to take us on a little tour through the energy sector this year. Actually, I guess I'll be guiding that tour because I've selected several energy ETFs that have caught my attention. So we'll talk about those. I'll also have Stacey offer a quick recap on the energy sector overall this year, and then we'll peek ahead to 2026. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. Okay, let me now welcome in our resident energy sector expert, VettaFi Stacey Morris. Stacey, always a pleasure. Thank you for joining me.
No, thanks for having me, Nate. Excited to be with you.
Okay, so you already know where we're going to start. It's where we always do, which is with the usual update on the broader energy sector. And then, as I mentioned, there are several energy-related ETFs I want to ask you about, and we can also look ahead to next year. But as of today, the Energy Select Sector Spider ETF, ticker XLE, that's returned about 7% year to date. And if you look at sort of in the middle of the pack in terms of all the sector Spider ETFs, so it is trailing the S&P 500 by about 8%. Now, if we look over the past month or so, when the S&P 500 has been a bit shakier, there's been a little bit more volatility, energy has actually outperformed. And it's one of only two sectors that's positive along with healthcare. And so just give us a quick backdrop here. Like, what's been going on with energy?
Yeah, I think, more recently, some of the things that have maybe caused the market to be a little more shaky are things that aren't issues for energy. So, for example, I feel like you've heard more about AI bubbles or tech being overextended, for a little bit there. And generally, when tech struggles, you tend to see energy catch a bid. And then there's also been some talk about interest rates and what's going to happen with interest rate cuts. And energy is a sector that doesn't need lower interest rates. So I think some of those factors that maybe weighed on the market are things that kind of work in energy's favor, and that's helped with kind of the more recent performance. But to your broader point about kind of where we are year to date, I think broadly the XLE is doing okay considering that oil's down almost 20%. Like if you had told me 6 months ago that oil was going to be down 20%, I would have assumed the XLE would be down too. That said, it's been more of kind of a stock pickers market. There's been, some good pockets of energy and there's been some rough pockets. Exxon and Chevron, which dominate XLE, are up a bit this year. But some of the producers, the oil field service names, the subsectors that are going to be more sensitive to what's happening with oil, have generally been weaker, with a few exceptions, where you've seen some stronger performance. But broadly, what we've been talking about for kind of months and months now in the energy space is just oil concern into 26. So Bloomberg consensus forecast for oil next year is just under $60. And as we're recording, we're sitting under 58 for WTI. So there's just been a lot of caution about kind of oil prices and broad expectations for us to be oversupplied kind of over the next couple months and into 26. And so that's really kind of kept a lid on the stocks overall.
You were alluding to valuations in some other sectors. So, of course, everybody wants to point to technology, or we can look at communication services. I'm curious, generally speaking, what do valuations currently look like across the broader energy sector? So, perhaps if you compare to historical valuations or even just relative to other sectors, can you offer any context around that?
Yeah, so I would say, generally, if you look at, EV to EBITDA multiples for energy, for example, they're pretty in line with kind of the 10-year average. Now, granted, the last 10 years for energy haven't been great, but the space is trading around kind of 7.5 times on EV to EBITDA, and that's pretty typical for kind of the average that we've seen. Now, if you look at energy relative to about anything else, it looks very cheap. So energy has the second highest trailing 12-month free cash flow yield of any S&P sector at 5.3%. The S&P 500 is at 2.8%. So screens cheaply there. If you look at price to earnings ratios for 26 estimates, energy is trading at like 15 times, whereas the S&P 500 is at 21 and a half times, or tech's up at 25 times. So energy doesn't look necessarily, super cheap relative to its own history, but any kind of relative comparison is going to tend to make energy look pretty cheap.
The thing that's still amazing to me here, and we talked about this last time you were on the podcast. I was looking this morning, and I know you know this stat, but the energy sector is still less than 3% of the weighting in the S&P 500, which almost seems hard to believe when you think about the weighting of some of the Mag 7. And that's why I wanted to ask you about valuations, because you look at that and it feels like maybe there's an opportunity here. But of course, it's been pinned down, close to that number for a while now.
Yeah, I mean, we've been stuck around 3% for a long time now. And when I started my career, it was, double digits. So that's been, I think, a bit frustrating. I think in 22, when energy kind of ran up and started to become more topical, there was a hope that we could get back up to those kind of double digit percentages. But, when you look at the relative performance difference between tech and energy over the last several years, it kind of helps explain why energy is still stuck at 3%.
Yeah, we used to have Exxon up at the very top of the S&P 500. It seems like a long time ago. Okay, so as I was alluding to at the top, I was looking through the energy ETF universe, and I want to ask you about several that stood out to me performance-wise. I would say both good and bad. I always just think it's interesting, sort of a litmus test, go through the universe, see what really pops up at the top of the leaderboard and towards the bottom. And the first one that just jumped off the page to me is the VanEck Oil Refiners ETF. The ticker symbol's CRAC, CRAK, pretty good ticker symbol. So that's up about 43% this year. Again, a clear standout among energy ETFs. Do you have any insight into what's been going on here with oil refiners?
Yeah, yeah. So, I mean, high level, if you think about kind of the energy space and who would benefit from lower oil prices, it's the refiners, right? So they're buying crude as an input, lower crude cost tends to be good. And when you have lower crude prices, you tend to have good demand. So typically that's a good recipe for, stronger refining margins or stronger crack spreads. And so refiners have definitely been kind of the bright spot within energy this year for sure, just from that standpoint. And then more recently, you've had a number of kind of unplanned outages globally. There's been a lot of issues with Russian refineries and attacks from Ukraine. And so earlier this month, you had Asia and European refining margins at 2-year highs. And typically, this is a time of year when refining margins are coming down seasonally. And so we've seen a lot of counter seasonal strength in just crack spreads and refining margins. And that's been good for the refining space. To your point about crack, the ETF, CRAK, it's about 30% US refiners, but there's a lot of kind of different things in that portfolio. You've got refining companies, petrochemical companies, renewable fuel companies. And so there's a lot of moving parts when you start looking at kind of those players across a global basis. So just, to give one example, the largest holding is Reliance Industries out of India, which is a refiner for sure. But they're also really, an Indian conglomerate, and they do a lot of different things. So all that to say, just, there's a lot of different exposures. And I think it speaks to something that you talk about often about kind of knowing what you own. But certainly for the US refiners, they have been kind of the bright spot within XLE this year.
Yes, it's a great point knowing what you own. That's why I always like having you on here because you drill down into these ETFs, you understand everything that's going on. And so some good points there. And again, I just like looking at this because I mentioned XLE up, whatever, 7% this year. And so it's interesting just to see which ETFs are outperforming in the sector or underperforming. I think it paints some interesting stories. And so on the other side of performance, I noticed that small cap energy companies have underperformed. And of course, if you just look at the broader market, everybody knows the story longer term of small caps underperforming. But the Invesco S&P small cap energy ETF, ticker PSEE, that's down about 11%. So anything of note here around small caps?
Yeah, I think, like any sector, if you go down the cap spectrum, you tend to take on a little bit more risk. And if you look at kind of what's in this ETF, it's a good amount of oil field services, it's a good amount of exploration production companies, those things that are really going to be more sensitive to what's happening with oil prices. So I think that's, more of the story there. Within energy, the more defensive names tend to be your large integrated like Exxon, like Chevron. And so just in a tougher oil tape, the smaller names tend to lag a bit.
Okay, one other ETF I'm going to ask you about, and I'll tell you, your colleague Todd Rosenbluth is going to love this because he is always talking about this thing. But I want to ask you, since you're the energy expert, not Todd. Todd's not the energy expert. The ETF is Nukes, NUKZ, so the Range Nuclear Renaissance Index ETF. That's up about 55% this year. And so, as the energy expert, you tell us, why is nuclear energy doing so well?
Yeah, I think, for nuclear, you've really had kind of the stars align. It's reliable baseload power, it's clean, it's got a lot of bipartisan policy support, which most energy forms don't have here in the US. And so it's kind of a perfect setup, I think, for the nuclear space. Nuclear, started to become more topical after Russia invaded Ukraine, and we started to talk a lot more about energy security. But then, since then, you've had kind of AI and data centers come along, and you've got, tech companies that need reliable power. They need a lot of power. They have deep pockets. They've got ties in Washington. And so you've got kind of all of these tailwinds coming together, and that's, very supportive for the nuclear space. We're the index provider now for the Range Nuclear Renaissance Index ETF nukes that you mentioned. So I'm spending a lot more time on this space as well. And it's interesting if you look kind of at performance, you've got some standout names like Oklo that's up over 300%, has definitely been, kind of a story stock in the small modular reactor space. But then you've also got, construction and services names within nuclear like Korea Electric Power Co. Or Samsung Heavy Industries that are up over 100%. So where oil and gas has been much more of like a stock picker's market and you need to kind of pick your points, the nuclear, you have more of kind of a rising tide lifting all boats. One other thing I'll just mention, within that index, about 30% of the index is utilities. So utilities are the second best performer in the S&P 500 this year. You hear a lot more about utilities as a growth story. And so they've got tailwinds from the nuclear side of it. But then also, things like lower interest rates are beneficial for utilities. So there's, a confluence of factors that I think make nuclear really interesting and special right now. But then also, you've got some other things that are working in the favor of companies that are in the utility space, for example.
Okay, so I have a question here. I want to have you talk more about AI and nuclear energy. And it's funny. So I was at a social gathering last weekend, and this topic came up, which you can tell we're a very fun group, right? Though actually, you would probably enjoy that group. But my takeaway was that the story definitely has the average investor's attention right now, right? You have regular people talking about this. And so I'm curious, how do you think about that from an investment perspective? In that, if everyone knows that these AI data centers need a tremendous amount of energy, and obviously nuclear can help provide it, is this all baked into the cake because my non-investment friends know about this story, or is there still an opportunity here, if that makes sense?
Yeah, yeah, and I'll be looking for my invite to hang out with that group next time. But more to your question, I mean, I think there's a couple interesting things there, right? Like, I think nuclear broadly is seeing kind of more interest and appeal and less pushback than maybe in the past. So if your friends are talking about it, as something that makes sense as a solution, I mean, maybe that's a good thing in terms of just showing that there's more acceptance and interest in nuclear now. But I think, more broadly, yes, we've seen nuclear restarts announced with big customers like Meta and Microsoft and Google. And I think that's all great and good. But I think there's still, opportunity here. Broadly, if you think about it, the US is trying to triple nuclear capacity by 2050. And so that would seem to suggest that there's, still a lot of yards to gain here. And I think there's a lot of interesting potential around small modular reactors. Another area where there's still a lot to do in terms of execution, but if you can get SMRs to work and be deployed at scale and those costs come down, there's a lot of potential there for AI data centers, but also geographies where it's hard to get electricity today, other types of industries. So I think there's still a lot of potential there. I think it's still a very exciting space. And I think in some ways it's positive that, people are talking about it and recognizing it, and it's not, maybe it's taboo or people aren't as concerned about it, and they realize that it's safe and they realize it's an effective solution.
All right, I'm going to relay that back to the group. You can tell I'm the life of the party anytime I show up at these things, talking nuclear and AI. Any other energy related ETFs standing out to you? Any others that you would highlight before we look ahead to next year?
Yeah, I mean, well, just kind of with the backdrop that we're looking at heading into 26 with kind of muted oil expectations and also having interest rates coming down. I mean, I've got to mention master limited partnerships or MLPs. The underlying index for the Illyrian MLP ETF is yielding just under 8%. I feel really good about MLPs continuing to grow their distributions and grow their payouts. And so not only do MLPs have, a higher yield than broader energy, they have a higher free cash flow yield. And like I said, I think this is a space where you're going to continue to see distribution growth. And if we see, some of that volatility in oil, MLPs and midstream tend to be a little more defensive because they are, essentially providing services for a fee. So with that backdrop, I think MLPs, especially if you're looking for income, are a space that still deserves some attention.
Okay, so without question, that's a space that you continue to look at. I know we've talked about that, over the past year or so. So an ETF like AMLP. With our remaining time, let's spend a few minutes looking ahead to next year because this is your last ETF Prime appearance of 2025, and so I'm going to force you to get out your crystal ball. So, what are some key stories around the energy sector that you'll be watching as we head into 2026?
Yeah, I mean, I think front and center is oil, right? It's just so consensus to be bearish oil into next year. And so, in some ways, that means, something could rock the boat and make it more interesting. But, I'm looking to see how oversupplied are we actually? How bad is it, or is it not that bad? And are we just more flattish, kind of like we've been mostly since August? So, keeping an eye certainly on oil. Heading into the winter, natural gas can always get interesting. We've seen some seasonal price improvement already. We get a freak winter storm or things like that. That can also kind of get interesting as well. So natural gas certainly part of the story, and more long term, looking more at natural gas demand trends and kind of continued growth markers there from LNG exports, but also power generation. We're seeing midstream do a lot in terms of supporting data centers and getting them natural gas for power. So that's something we'll kind of continue to keep an eye on. On the nuclear front, I think it's keeping an eye on kind of milestones for some of these small modular reactors, and also seeing kind of what continued policy support we get out of Washington, and how do we move towards working on large reactors and kind of revitalizing that, really revitalizing that industry in the U.S. since we've only done a few reactors over the last decades at this point. So those are some of the things that I'll be watching for. But I think from a traditional oil and gas standpoint, a lot of the emphasis is going to be on oil.
On the policy front, or I would say even the political front, is there anything in particular that you'll be watching, given that we do have midterms next year? And I know, again, we've talked in the past just about, and I'm a big believer of not mixing politics with portfolios. Oftentimes, these can be very short-term drivers, or they can impact sectors on a very short-term basis, not really a long-term investment play. But is there anything noteworthy there that investors should be keeping an eye on as we head into 2026?
Yeah, I mean, I think, a lot of kind of traditional oil and gas, the maybe wish lists they had with this administration in a lot of ways, I think has been checked. But the big one that hasn't is permitting reform. So if that's, going to get done, this would kind of be the time to do it. So that's one that I'm watching for. I think there's also some other kind of bipartisan acts that are out there that would be supportive for nuclear that, could bear watching. But those are kind of the things that come top of mind to me.
And just kind of bookending our conversation, I had mentioned earlier, just energy being less than 3% of the S&P 500. Let's just say hypothetically the Mag 7 does experience some weakness. Maybe these market cap weighted indices roll over a little bit. Do you see energy as a place that investors might go to? I mentioned over the past month, well, the S&P has been a little bit more volatile. Energy has performed a bit better. Could you see that as a space investors run to?
I think that's possible. I mean, I think there's other factors there that could be determining what people run to as well. Normally, it feels like when tech struggles, people rotate into energy, and I think that would be a good thing. But at the same time, you've got kind of this oil overhang. So does that keep people from moving into energy maybe as much as they would have otherwise? Does something happen that kind of makes that less of an issue? What's going on with interest rates? Like if people are expecting fewer interest rate cuts, and maybe that's another reason to kind of get into energy. So there's a lot of different factors there, but I think just anecdotally, if you look at what we've seen kind of performance-wise for quite a while now, when tech struggles, energy tends to do a little bit better. So certainly that's possible if we see some weakness in the Mag 7.
Well, also though, the tie-in with AI, which we were talking about, that if there is some weakness there, maybe my friends won't be quite as happy what happens around energy, if there's that tie-in there. But Stacey, excellent perspective on the energy complex as always. Thank you for joining me.
No, thanks for having me, and happy Thanksgiving to you and your audience too.
You as well. That was Stacey Morris, head of energy research at VettaFi.
Markets are always evolving. The whole tactical U.S. ETF HTUS uses quantitative models to tactically adjust exposure to U.S. equities on a daily basis. It's about adapting with discipline. Learn more about HTUS and how it can complement your investments at wholetacticalfunds.com. Carefully consider the fund's investment objectives, risk factors, charges, and expenses before investing. This and additional information can be found in the fund's prospectus, which can be obtained by visiting wholetacticalfunds.com. Read the prospectus carefully before investing. The fund is distributed by Northern Lights Distributors, LLC. Looking to put idle cash to work? Discover AMUN, Aberdeen's ultra-short municipal income ETF. Designed for high after-tax income and capital preservation, AMUN targets muni market inefficiencies with disciplined risk management. Invest smart, stay short. Learn more at aberdeeninvestments.com/active-ETFs. AMUN, where short-term meets smart strategy. An investor should consider the investment objectives, risk, charges, and expenses of the fund carefully before investing. To obtain a prospectus containing this and other information, please call 1-844-383-7289. Read the prospectus carefully before you invest. Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by JD Gardner, founder of Aptus Capital Advisors, who currently offers 14 ETFs, nearly $6 billion in assets. That includes a brand new series of buffer ETFs that just launched in October. And as I noted at the top, these are now the lowest cost buffer ETFs on the market. Only 25 basis points, which that certainly caught my attention. And JD is now joining me from Alabama. JD, it's been a while, but great having you back on the podcast.
I appreciate you having me. Excited to be here, and thank you, Nate.
Okay, so Aptus did recently roll out the series of buffer ETFs, and I'm going to have you explain these in a moment. I would say they're pretty straightforward, right? There's a 15% downside buffer and then the usual upside cap. But as I was just saying, the kicker here is that you launch these with an expense ratio of 25 basis points, which does make them the lowest cost buffer ETFs on the market. If we exclude the buffer fund of funds ETFs, but if you look at those end up having a much higher total expense ratio, right? When you add up the cost of all the underlying funds. And so let's start here. I'm curious, why did you decide to enter this category, which I would say is highly competitive?
Yeah, so could be a long answer, but I'll be as brief as possible. So we are an options-based shop. That is what our general view of portfolio construction in today's market is one where we'd really rather investors allocate more towards risk assets and away from the traditional conservative assets. And I think buffers they help kind of push forward our asset allocation framework. Now, I will say that with the caveat of we don't necessarily love some of the issues that come with buffers, but one of the biggest drivers is obviously there's a huge, huge appetite for these things. You've got the AQR argument against them. I'm sure we can get into some of that, but the big thing, there's a market. I do think it aligns with some of our kind of just higher level views on portfolio construction. And we do think that our value is, if you're going to inject value in the ETF space, you either have to do something really different and charge for it, or if it's going to be a similar structure, you need to strip out as much of the cost as you can. And we've obviously chosen the latter of those two ways to inject value.
Yeah, and on that latter point, you recently wrote a piece comparing your buffer ETFs to Cheerios, right? The cereal. Do you want to explain that? I love that.
Yeah, and so shout out to Brad Rapking in my office. He's had a lot to do with some of the derivatives exposure that we have today. But we were talking about the buffers, and his simple question was, where do you want to buy your Cheerios? You want to buy them at Walmart? Or you want to buy them at Publix? And so we actually went and we have Publix down here. I don't know if Publix is everywhere, but it's kind of like a higher end, grocery store. But we did a little digging, and they're significantly more expensive at Publix than they are at Walmart. Same brand, same thing. You pay more at one place than you do at the others, and that's kind of where, being an options-based firm and having the guys that we do and the gals that we do, it doesn't make sense for us to have sub-advisors and extra hands in the cookie jar, for lack of a better term. And so we launched these things, and obviously we're doing everything internally, and we can pass along that value to shareholders through lower cost.
When you talk about those extra hands in the cookie jar, I'm curious, if you look at the buffer ETF category overall, is that why you think fees on these products have remained so high? Because I was looking at the category this morning. There are a bunch of ETFs out there with expense ratios of 70, 80, 90 basis points plus. And just eyeballing the category overall, it looked to me like pretty much all of the straightforward buffer ETFs are over 50 basis points. And so, why do you think nobody attempted to undercut the market as you're doing, especially given that critics of buffer ETFs, they often point to fees as an issue, right? And then you add to that, JD, that these products aren't new. This isn't a new category. They've been on the market for a while, and there are multiple larger ETF issuers involved here. And so, why do you think this category had not experienced the normal, ETF terror dome fee pressure?
I have a lot of thoughts on that, on the potential reasons, but some of them probably more cynical than others. The biggest thing is, that's what we kept saying, is that these aren't like novel strategies. This is very plain vanilla, kind of like a single trade annually for the most part, if you look at where the AUM sits. And so it was, somebody needed to come in and lower the price point, just because I think the going rate for effectively a collar that's adjusted once every year does not need to be 70, 80 bips. Now, people are willing to pay it, obviously, but I think that and I won't get into this, Nate, but I think there's the idea of like strategy creation and then distribution. Like, that's the one thing the ETF space, if you're not in it, you don't really realize, like, you could be the absolute best PM, create the best strategies in the world. If you don't have distribution, it doesn't matter. And so the name of the game is AUM. And so I think a lot of it has to do with the distribution arm, maybe tilting the scale more so than the strategy arm. And we feel like we obviously think we have good strategies, but for buffers specifically, it was just time for somebody to launch a lower price strategies.
But just to be clear on your point on distribution, and we don't have to get into the ETF industry, weeds here, but if I'm hearing you correctly, you're saying that because some of these larger players obviously have distribution, they can get their products in the hands of investors. Are you saying there wasn't as much impetus to reduce fees because they're able to get their hands or their products into the hands of investors? They can charge it 70, 80 basis points. It's just interesting to me because certainly when these products first came out, which I think was, we'll say 2019, somewhere in that neighborhood, they were novel, disrupting what I would say is a traditional structured product category, which we know that's extremely expensive if you look at traditional structured products. And so it made sense to me that they could charge a higher fee and investors would pay that. But again, as I was saying, these products have been around now for years. And you just talked about, there are some more complex strategies, but some of these are very straightforward option strategies that don't cost a lot to run. So it's just the fee aspect is very interesting to me.
But the distribution is one simple way to look at it is, if you can go get distribution at 80 bips, why would you go get it at 60 bips? That's, so I think having kind of the muscle behind distribution really matters towards where fee levels are set. But also, when you look at the structure, and I'm not picking on anything, but when you look at like an Aptus buffered strategy, you go to the prospectus and see who's involved. It's Aptus, period. You go to these other shops and it's going to be them, which in my opinion, they're kind of the distribution arm, but then you've got the option expertise via sub-advisor relationship. And so those fees start to stack, and everybody wants to get paid if they're putting time and energy into something. And so we just kind of reduce the size of the stack. And then, we view these as a really great way to open conversations for us to have kind of like our asset allocation discussion, which we think is where the value lives.
Okay, so in terms of the ETFs themselves, do you want to explain the basics on how these work? We can take the Aptus October Buffer ETF, ticker symbol OCTB, use that as an example. Do you want to walk through the basics here?
Yeah, so we launched four, kind of like a quarterly buffer. So the simplest way to view them as, if you have a 15% buffer, let's just say you own S&P, 15% buffer. What that means is if the market's down 20 and you have a 15% buffer, you should be down roughly 5. If the market's down 30, you should be down roughly 15. So your buffer is where your protection lives. So that's the known variable. So we know that one, and then you have to solve for the upside. So think of it as like most people have heard of a collared strategy where you're long an asset, you set a floor via puts, and then you sell covered calls to help fund that protection. And what those covered calls are effectively set as is a ceiling. So you have the long asset, you have a floor, and then you have the ceiling. And so the value in that is there's some like comfort. We see a ton of advisors and a ton of allocators utilizing these products as, hey, we have a defined amount of risk on the table where there's some certainty with our protection. And so you have to welcome or have to be good with some of the trade-offs that you get, which is obviously if the market runs 30%, you're going to be capped at some point. And those caps are set by, it's not the same cap every time you go to trade. So we launched quarterlies, 4 of them, and we view those as, we didn't want to launch one because there's a ton of path dependency in these things. So we wanted to launch at least 4 of them to kind of mitigate some of that.
Do you want to explain what you mean by path dependency in these products?
Yeah, and this is one of the things that we've spent years saying, hey, this is just like an extra layer of work that you probably don't need to onboard, because we think there's better ways to get the protection of options and the potential asset allocation benefit of options. But like if let's say today, we own the S&P 500 and we buy a put. The S&P is at $100. We buy a put at $95. That means we're long a put. So if the S&P goes below 95, we have the right to sell it at 95. It's really valuable if the S&P goes to $70 and we have the right to sell it at 95. Well, let's say kind of like the whole tariff tantrum earlier this year. Market sells off 20%. If we're long a put, that put makes a whole lot of money. So the deltas on that put go from a small number to a big number, which translates to, hey, your asset is down. You've lost value in your asset, but your put protection is up. That's all great. Let's say you come into that structure where my asset has deflated and my put has really increased in value. Well, if you allocate to that strategy because, hey, it protected wealth when the market sold off, well, you're probably buying an extremely bearish position at that point, meaning you can't make any money. Because when the market does rebound, you're going to have this huge anchor of a drag in your puts deflating in value. And so if you think about this thing being set once a year, the market doesn't just go up linearly. It's has good months, bad months. And so the path dependency varies all the time. And that's a variable that is an issue, because if you're like, think about like an advisor allocating to models and you put one of these strategies in. Well, Nate, you could allocate in January and have a certain amount of potential reward for the risk that you're taking. I could allocate in March and have completely different risk metrics. And some of them are much uglier than others. And so that's what I mean by path dependency. All option strategies are going to have some form of path dependency risk.
Yeah, and I would say with buffer ETFs, a way that I very simply like to describe this is very basic, is just that they're point-to-point investments, that in order to get what's on the label, so in your case, the 15% buffer and then whatever the upside cap is, you have to invest on day one and hold throughout the entire outcome period, right? If you're buying intra-period, you're going to have a different experience. I guess one thing I'm curious about here is, how is Aptus ensuring investors understand this? I'm assuming you have tools on the website, obviously in discussions you have, but I think this is a key point.
Yeah, it is. And I would say, so first off, to the Aptus answer, yes, we are in discussions and we have deep relationships with advisors where these are the things being discussed with anybody that's interested or utilizing our buffers today. The website is a huge source to just go understand where's the cap, what's remaining on the buffer, all of those what does the underlying look like, all of those things. And I would kind of hat tip to the industry, like they're doing a great job of like helping to communicate, because this is the most important thing, not only explaining the structure and what it is and why we would use it, but then once you're invested, well, there's a huge need, because of the path dependency, to communicate ongoing where things stand. And so the website's huge for that. And I do think one-on-one conversations. Because Nate, you probably know this as good as anybody being involved in this space. I could sit down with you and describe a buffer strategy today for the next hour, and you walk away an expert. And then a month from now, you have no clue what we discussed. And so we see anything options related, the need for communication is just, in our opinion, it's just much greater than being kind of like long only investing.
Okay, so let's set fees aside for a moment. Again, you have the lowest cost buffer ETFs. Let's set aside what we just talked about in terms of the point-to-point nature of these investments or the path dependency. As you were alluding to, buffer ETFs have generated a lot of debate. You mentioned Cliff Asness and AQR. There's been a number of prominent investment voices that I think have been negative towards these products. And quite frankly, JD, I would say I've been somewhat critical of the space myself. And the reason is I think most investors can just manage risk through asset allocation, right? They can add more high quality bonds to a portfolio if they can't stomach the equity risk, those sorts of things. So give me the counter argument here. Like, why doesn't that work for everyone?
Okay. Yeah, that's a great question. First off, I'm not smart enough to argue with AQR, but we tend to side with AQR. Now I know we're talking about our buffers, and I should be like pitching the value there, and I'll get to that. But I do think a lot of the points they make are valid. I think there is some disconnect with a typical advisor and their client than like an AQR, rationale might be a little bit too institutionalized. So the strategy by itself, is there a better way to get options exposure and accomplish some of the things that we think really matter? Yes, I think there's better ways. But for the majority of wealth management, we have this really strong conviction, given the fiscal backdrop that we have, that we call bonds certificates of confiscation. And we firmly believe like your real return is ultimately what matters. We think all financial plans work with higher CAGRs. We think bonds are going to have a very difficult time to generate positive real returns in the future. Now, that means, so at the allocation level, that translates to, okay, well, Nate, let's just don't own bonds and let's own stocks. Well, there's a lot of issues with that. So like as a business, we get the benefit of like, we get to talk out of both sides of our mouth, which is, Nate, you need to hold way more risk assets, avoid bonds if you can. Well, how do I handle the risk that comes with the vol of equities? Well, you need to hedge away that risk. And so where to accomplish what I just said, more risk, less conservative, do it in a risk neutral way, specifically from a drawdown standpoint, you have to have options, in my opinion. And I guess one caveat, because everybody's used to this, Nate, if you're more conservative than me, maybe you're 60-40. If I'm more aggressive, maybe I'm 90-10. That logic makes sense if that 10 and that 40 can generate real returns. But if that 10 and 40 can't, well, then what do you do? And so that's where income, like options-based strategies, and let's focus on buffers. I think buffers help. This is the positive side. I think buffers help allocate towards more risk and less bonds because there's that like comfort in that buffer and that known outcome. And that's where I think that I would like counter AQR. Again, I agree with a lot of what they say, but my counter is the typical wealth management client. If you can adjust their allocation from 60-40 to say 80-20, and you could do it in a way that they're comfortable with the additional risk that they're taking, I think that translates to higher compounded returns over time, which is a huge value for the client, the advisor, et cetera.
When you talk about that comfort from an investor, the known outcome, I feel like investor behavior is at the heart of pretty much everything Aptus does. And you just described, I feel like your firm philosophy overall really well there in how you view bonds and hedging away risk with options. But I do feel like your entire ETF suite is constructed around trying to help investors minimize bad behaviors. Can you talk more about that? Just why you think that's so important?
Yeah, for sure. This is so the wealth management space in general. Like if you said like, hey, Nate, define risk. like what most risk managers are going to be like, well, my strategy had a 16 vol versus an 18 vol. And like we understand all that, but what we don't understand is how most asset managers can't realize that like a lot of the things we talk about is irrelevant to the end client. And so we really put an emphasis on let's talk about things specifically risk. What are measures that we look at? Like why do those matter? Like let's frame everything in terms that are easily digestible by the folks that are going to ultimately be exposed to our strategies. And that's where like drawdown risk is the simplest. If you give somebody $1,000,000, they worked 20 years, they stashed away money, they got $1,000,000 in their retirement account, they're ready to be done working, and the market sells off 30%. And you're talking about $1,000,000 household that might have made 150, 200 grand at most, watch their account evaporate by $300,000. Like the behavior that comes after that is probably not going to be conducive towards compounding capital in the future. And so that's where we're huge advocates that, hey, let's build the bigger engine, like David Dredge says, like let's build the bigger engine so we can go fast when things are great. But when things actually don't stop, when things do, we hit a curve and things slow down and we get a recession or a pullback in the market for whatever reason, that's where you have to have something that not only helps you compound better, but helps the behavior stay in check, which ultimately that's what matters. And that's why we're such advocates on the convexity that options bring, because it's a known correlation. And that I can't overstate the importance of that.
I think I always like to boil things down to a very basic level. And what you just described there, the way that I like to paint that is the best portfolio for a particular investor is the one that they can stick to, right? That somebody could be in the best investment strategy in the world, but if they can't stomach the volatility, if they can't stick with it, it doesn't matter. At some point, those bad behaviors are going to manifest themselves and they're going to miss out on compounding because they're going to sell at the wrong time or buy at the wrong time. It always gets back to that. And, the type of portfolio that an investor can stomach, obviously that's different depending upon the investor and what their makeup is and the types of behaviors that they exhibit. So I thought that was really well described. Going back to the fees on your buffer ETFs, again, 25 basis points. I have to ask you, just from more of an industry perspective, do you have any concerns that these ETFs start making some real noise, which they're off to a nice start, by the way, but do you have any concerns that investors really start gravitating towards these things and then larger players come in and start competing on fees?
No, and the reason for this is we hope that happens. That's we feel like there's a need. So structured products is a huge market. We like to find outcome ETFs better than structured product because of there's a lot of reasons. Well, if they do come compete with us, like these are not a suite of strategies that we're like, hey, the Aptus buffer shop. That's what we would like. That is not what we want to become. We can do this. Like, here's the secret I'll let you in on, Nate. These things trade once a year. So how much work is it on our part? Yeah, we've got to rebalance. We got to do things like that. We're like, got to make sure that we don't have any hiccups, but there's no reason for these things to be 80 basis points. And so let the market come in and we manage buffered portfolios that aren't Aptus strategies. We're so involved with these advisors and like what's out there. If we could build a portfolio that costs 20 bips and not 80 bips and still accomplish their like desire for buffered strategies, like we would be all for it. And we are not going to, I do think our roadmap from a strategy standpoint, there may be a few more buffers in it. But we're not pivoting as a firm to say, hey, there's huge demand. This is an internal phrase. I probably shouldn't say it on a podcast, but like we view these buffers as marketing expenses for us. Like hopefully people get the benefit through lower expenses, but like what better way to increase conversation? Because there's a ton of advisors that use buffers and we feel like they have to look at our strategies because they're the same thing except 1/3 of the cost.
So again, I'll boil that down to a very simple takeaway for me, which is that Aptus, running buffer ETFs like this, you do this in your sleep. You mentioned, one trade a year, but the industry as a whole has really sold complexity here. that there's a lot going on underneath the hood, which justifies the 70, 80, 90 basis points. So I like how you painted that there. And that, again, you make one trade a year. Right? We're overstating a little bit, but that's essentially what it is. You set these up front, and that's it.
Yep. The difference in like an active based option ETF, where you're truly managing path dependency, adjusting daily, resetting the sticks, like navigating different vol regimes, all of it, like it's so different from these buffers. And I'm not downplaying. I think these buffers are great. It's a great tool for people to have exposure to, and for advisors to use when they need. But yes, you're exactly right. I just think there's a different level of workload. And I can sell you on convexity or complexity as much as I want to, but these things are not very complex if you actually have any type of options background.
All right, but you could see a scenario where you do launch some additional buffer ETFs.
I could. I think yes, I could see a scenario.
All right, just a few minutes left here, and actually a good segue. So as you noted, Aptus, you're not looking to be a buffer ETF shop. And so let's highlight another ETF outside of your buffer suite, I think, to give people a flavor for what Aptus brings to the table. And you do have, in my opinion, a very unique suite of risk managed strategies. I would encourage everybody to go take a look at these. I find them very interesting. But I'm going to pick the most popular one, which is the Aptus Collared Investment Opportunity ETF, ticker ACIO. So I showed this currently has, about $2.2 billion in it. And I've described this in the past, and maybe you do as well. This is the poster child for Aptus's investment approach overall, in my opinion. So you want to briefly highlight that? Again, I think a good example of the type of value Aptus is bringing to the table.
Yeah, so ACIO is internally called the buffer killer. And that's where it's like, I think the compounded returns in ACIO will continue to outpace buffer strategies. So what ACIO is same thing I said earlier. It's long a basket of equities that are going to be highly correlated to the S&P. And then there's short calls and there's long puts. The difference in ACIO is that there's really two major differences. One of them is we sell covered calls on the individual equities. We buy puts on the index. And here's the reason why. No, there's no ARB opportunity. Like NVIDIA is trading at 80 implied vol and the S&P trades at 18 implied vol. Those aren't exact numbers. I'm just giving you an example. But like there's not a vol like arbitrage opportunity there. There's a reason NVIDIA trades at 80 implied vol and not 18. But given that we've got a correlated basket, so our stocks correlate with our hedge. So like if our equities track the S&P and we're using puts on the S&P to protect it, well, then we can sell higher implied vols to do what? To set the ceiling higher. So if you look at a typical collar strategy, your long stocks, your short calls, that's your ceiling. Your long puts, that's your floor. Well, typically, if you say, well, I'm going to set my floor at 95, so 95% below. Well, to solve for what amount of calls do I have to sell, you might only be able to go up 3% because puts are more expensive. So I sell 3% higher, collect the premium, go buy the puts for protection. Well, those might be 5 or 6% lower. Versus ACIO, because we're selling elevated implied vols at the stock level, we tend to be able to set a higher ceiling. So that's the structure of it's the first thing. The second thing is simply we manage this thing every day. And that's where if our puts go from a 30 delta to a 60 delta, we got to adjust them. If our calls, one side note on our calls, and I'll give Mark Callahan a shout out and John Luke Tyner, two of the best options guys you'll find. If we sell a call, man, we could have a whole nother podcast on like income generating option strategies. But if you sell a call in say Microsoft for $100,000 and Microsoft has a bad earnings report, it's down 6%, your $100,000 premium turns into $20,000, which means you collected 80% of that, right? And if that happens in ACIO, we're killing it. We're taking our 20, but we made 80 grand on it. We'll leave 20 on the table and we'll look to do the next one. What most people do, and we've had this conversation, we've been doing this for 12 years now. So are just running Aptus is 12. ACO is not 12 years old, but the thing that the recurring conversation is, I just sold $100,000 of premium, Nate. Well, let me know when you buy it back for 500,000, because that's going to hurt. And we want to, like, we are not a short vol shop. We are the opposite of a short vol shop. We use it to get the benefit of some of the other things we're doing. But that's one thing ACO is very different, is that when we realize some of our short vol profits, we're very quick to take them, because we would rather let the underlying compound rather than chop it off.
So if you were to just boil that down, I just want to be clear, how should investors think about ACIO compared to a traditional buffer ETF?
Yeah, so it is a buffer type strategy in that it's got the same structure, but that path dependency that we talked about, in our opinion, it is a more effective expression of a buffer strategy. And really, we view ACIO as almost like a 60-40 alternative. So if you look at it, that's why we created it, is to say, I'm 60-40. Well, can we get you to be 85-15 with a very similar amount of risk? Well, the over allocation of equities, in our opinion, should be in something like ACO, which obviously is not like a beta of 1. There's going to be a much lower risk profile with it.
Well, JD, we're going to have to leave it there. This was fun. Really enjoyed the conversation this week. Best of luck on the new Buffer ETF suite. If nothing else, creating some pressure that benefits investors who are in these products by bringing fees down. So thank you for that, and congratulations on all the success Aptus is having. Again, I really feel like you're such a great ETF success story. So congratulations, and thank you for joining me.
Well, thank you. And thank you for the work that you do. Really, the guests you have, the things you highlight, we appreciate it. And obviously you've had some really good people. I hate to bring down the caliber of people, but I appreciate you having me.
Hey, thank you very much for that. That was JD Gardner, founder of Aptus Capital Advisors. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Clark Allen, head of ETFs at Horizon, along with Mike Hagopian, institutional portfolio manager at Fidelity. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.